The Federal Reserve has just had their most recent meeting and everything has changed. Nothing's the same before, and we are going to go over what this means for the housing market and for multifamily investment specifically. We've got articles from the Federal Reserve. Their new economic projections is quite revealing about the state of persistent high interest rates. We have reports from CBRE, Yardi Matrix, RealPage, Cushman & Wakefield, Moody's Analytics, CoreLogic, and more. Stay tuned for the best information on the multifamily investment market, the housing market, and the macroeconomy here on The Gray Report. Hi, and welcome back to The Gray Report. This is Matt Bosnagel. I'm filling in probably inadequately for Spencer Gray, but we'll see how that goes. I am joined by a much more adequate and perhaps even excellent Addison Lubert, who is the Associate Asset and Asset Management Analyst. Did I get your title right there? Senior. She's okay. I'm very sorry for inadvertently demoting you. I am trying to compliment you here, and I'm fumbling madly. But I'm very glad that you've joined me, and I'm sure that we're going to make this a good episode. How's the week been?
It's been good. Can't complain. I will say you missed a good opportunity to demote me and then pull the. You haven't heard?
Oh, yeah, that's good.
They haven't told you yet?
I'll put that in there. Once I start overthinking, yeah. Okay, I think we should just jump into the first article here. I wanted to start with these reports from CBRE and Yardi Matrix. They're kind of, now we had an update, an overview of all the markets from CBRE last week, and we covered kind of their changing economic projections. And this week, CBRE has a mid-year pulse check on the U.S. multifamily market, kind of drilling in a little bit more closely with their assessment of multifamily. Interesting that they note here the amount of investor attention in the multifamily market. They say right there is like kind of their second bullet point. For the first time since CBRE began polling investors, respondents to CBRE's Global Investor Intention Survey in late 2022 said that they would target multifamily properties more than any other property type this year. I think that multifamily has ranked at or near the top of a lot of other lists of kind of investor preferences. So I'm not really that surprised that it would rank so highly here. I am interested in kind of like the level of like how much they're leading other assets. And it's not like a dramatic increase, but it does reflect, I think, a greater attention on multifamily, probably as seen maybe as like a little more stable than other sectors. I think office has its own problems. Industrial seems to be still like pretty healthy, but it's not like it was, even like last year. And retail is, it's just a little bit more ups and downs. It's strange to think after, such highs and lows, and really multifamily has had a bumpy ride itself, just relatively less bumpy maybe. And I think investors are probably kind of cluing into that. I don't know if you've seen any increased investor attention. I asked you this beforehand. My big question for you is kind of a larger question. Are you seeing more competition amongst other buyers for a given multifamily property than you are now? Are people kind of falling away? Are investors crowding in? Like how much attention, how scared or attractive is scary or attractive is the multifamily market for investors right now?
Well, there's two different parts of that. I think we have, on deals that we've looked at and deals that we've come close to penciling on, we have had I don't want to say a ton of competition, but there hasn't been a deal that I can think of where it's been we're one of three people or one of two people total during the whole process. I think what's going on is you have a lot of people that are on the sidelines that want to transact, that want to buy. Mm-hmm. Nowhere near as many people that are interested in selling. A lot of the sellers are people that are in a tough spot because of the type of debt that they put on their property, or they missed the mark on a refinance, or just, really, the only times you hear about someone selling because it was a part of the business plan seems to be as if it was a development project, or new development, I should say, and they're in a lease up. So I think in that sense, there's still a lot of people that are waiting to get active, and they're looking at every deal they can. And I think that competition is different than what we saw in 2021. A little bit of 2022, but I would say more so 2021, later half of 2020, where you could see some people missing deals because it was a matter of it's not that there's anything wrong with the deal or anything wrong with the fundamentals. It's the fact that that would be their fourth closing in a year and they just couldn't swing it. Or they had other issues going on, or we didn't look too hard at that deal because we were looking at something else.
Yep.
This year, because it seems like the new supply coming out for sale has been a lot less than what it's been in the past. I think pretty much every deal that comes out, you're going to get, I mean, I would say, keeping this small and local in Indiana, I would say any deal that is coming out, it's going to get looked at by at least everyone that's an owner operator in Indiana. And then you're going to see people that are around the Midwest that have been looking at it. But also, I would say when we talk about investor sentiment in multifamily and industrial, I think what props up both those things is there isn't really any fundamental changes to multifamily and industrial. I mean, I don't know as much about industrials as I would say multifamily, but I don't see anyone necessarily calling out renting an apartment, or since COVID happened, I don't think of anyone coming out and calling into question why you would rent an apartment or anything like that. The way with retail, seems like ever since the 2010s, or really since Amazon broke onto the scene, it's just, well, how many more years are these malls going to exist before everything's online? How is retail going to change? I mean, there's always been a lot of that.
There's a larger question mark around retail, I think, and I think for good reason, office. I think retail in some ways is like, well, it's stuck around for so long, it seems almost more persistent maybe than office.
Well, and going to the office situation.
But yeah, even then, I think office is not as bad as maybe some people might think.
But also, I mean, when it comes to office, though, you're not dealing with rents have fallen because there's new supply in office or anything like that you would say can kind of affect different markets within multifamily. What seems to be the main issue in the office space is just that people, remote work has become a thing. And it's not risk. I mean, yes, there's obviously issues that the owners and operators are facing, but it's a lot of companies that are saying we just can't attract talent wanting or forcing them to come in 5 days a week. There's plenty of stories I heard across the country, and I remember reading of someone in Chicago where the guy really tricked out the office space to have a mini basketball court, just a bunch of different amenities, and he's like, people might come in, but it's 3 days a week. So I think multifamily just isn't really facing anything like that. So I don't. No, I think to me.
Yeah, I think that rings true. It puts a lot of the kind of rent slowdown in perspective, given the kind of the larger pallor that's over all these other sectors, and it's big question marks. Even in industrial, how much can you keep up? The producing more goods. Are we really transitioning into a more service-based economy? So there's larger things and things I don't understand.
Well, I mean, industrial, from what I've heard, is it's not so much that the fundamentals are bad. I've heard more so that a lot of people are looking just for shorter term leases and everything. But again, and then I think that's also another thing that doesn't quite get factored into here is that with the multifamily market, there is some certainty in the sense that this person at the very least is going to be here for 12 months. Obviously, for some shorter leases, you can do some longer leases, but there's kind of a refresh period. There's stuff you can do immediately on the property that can kind of get things churning, where with industrial, retail, anything like that, you do run into the risk of, well, I've signed a 10-year lease with this company, and if they're not, they don't have a great credit rating, or it's not a corporate guarantee, there's a lot more risk there. But yeah, I don't, to me, that was nothing surprising in terms of just kind of multifamily and industrial basics compared to the other group.
So there's a large amount of people interested in multifamily. Specifically, they note that 50% of multifamily investors view high risk, e.g. opportunistic, distressed in debt, as the most attractive investment strategy in 2023. This was more than both office, which had 40%, and industrial, which had 45% investor groups, which I think, that actually makes a little bit of sense of the relative position, because if multifamily is a little more stable, maybe they have more appetite within a more stable sector for a riskier strategy. But I keep thinking about, I've heard about dry powder. I know these people are waiting for, this perfect opportunity. keep thinking about the situation where everyone is looking for this diamond in the rough, this perfect deal where the owner is running away from an expensive loan and the property is distressed but still has great cash flow, and it's like, you're at a certain point, it's like you're kind of putting your fishing line out on the dock and you're hoping a prize marlin swims by. It's probably not going to happen. I don't think we're going to see these golden opportunities popping up right or left, but I do think that upcoming loan maturities are going to put a downward pressure on cap rates in Q4 of this year and into 2024. But I was also thinking, and this is kind of my larger point, what if upcoming loan and it's kind of the like skeptical or pessimistic view, really, is what if upcoming loan maturities, whatever effect that they have with higher interest rates or whatever to kind of push cap rates up and make deals more palatable for buyers, what if that doesn't really happen because people are so competitive? What if, just like at the beginning of the pandemic, people are waiting for amazing deals that just don't emerge, and the real discount is that prices are just slightly stable instead of measurably lower? To extend kind of what I was trying to say with my fishing analogy, minus the fishing, is there are these people out there looking for this perfect deal. That's only a portion of investors, though. There's a whole range of investors, some with a return threshold that's lower than the people out there looking for a perfect deal. And there's a whole, these buyers might not be knocking it out of the park, but if they've got a plan, they'll buy. And I think that these investors are out there. And instead of like huge opportunities, the opportunities that may happen are ones where, property values may go down enough. It may just be normal, maybe a single or a double or whatever, to use the baseball analogy. It just may not be excited enough to get some people off the sidelines. Now, what I think this would have, the effect that this would have on the market, if there's so many people competing for deals, then the prices aren't going to go down to make it this perfect. I'm imagining this deal that people are looking for where property values go down enough for them to find a deal. This is the environment, but they also start to go back up again, so you make money when you sold it. It's like you're kind of betting against two things that are at odds with each other, and that's the skepticism I have towards the emergence of this perfect, where it's going to be a case where not everyone's going to be happy. Not everyone's going to be able to find a good deal, and not every seller is going to be happy parting with their property. Now, I still think there's going to be risk associated with it, and there are too many investors who have multifamily as their priority, such that, if things are too competitive, even when deal activity is down, I think if the math works out for a given property, then they'll come out of the woodwork. I don't think it's, I like before I said, yes, plenty of these people are waiting for the knight in shining armor to come along, but I think that's not necessarily going to be the case. It'll be, once the math works out to be like an above average deal, people will come in there and it'll get competitive again. That's like my realistic take. I think there's room. It's still like the onus is on sellers to make this math work, because it hasn't in the way that it has before, pre-pandemic even. But once the numbers are there, you're going to see a ton of competition. So I don't know where the opportunity is for someone like you to find that before everyone else does.
Real quick, I am surprised when they say 50% of multifamily investors view the high risk, opportunistic, distressed debt as the most attractive investment strategy. I'm surprised by that, because I'm thinking of it in the sense where it's deals that have significant value add component to it, or operations are in just such a tailspin that they need someone else to come in and fix things. I'm surprised that that amount view that as the most attractive investment strategy, just because what we've seen and heard is it still seems like there's a lot of investors out there that are placing a premium on cash flow right now.
Yeah.
Not necessarily changing their thresholds on IRRs or moving the needle there, but cash flows at a premium. I don't know if that's going to still be the same in 2024 and moving forward, but general rule of thumb is you want something that's going to be at, if not better than where the treasuries are at in terms of a cash on cash. Mm-hmm. And those deals, the opportunistic distressed, assuming you get things right on the value add, mm-hmm. assuming you get things right turning around operations, or both if the deal requires, the cash flow is going to be there at some point, but very rarely is it there the first year or two.
Yeah.
Unless you're putting, I don't know what it would look like, I guess, with floating rate debt or anything like that. But a lot of the deals that we've looked at and underwritten that kind of have that kind of component, the cash flow isn't the best it could be year one or two.
Yeah.
So that was surprising to me. But that also goes kind of the point that I started off the show with, in that I do think you're onto something about kind of where the competition's going to come and where it settles things cap rate wise. I think looking at pricing of deals that have come to market right now, I think sellers and or brokers have, I know come to grips probably isn't the most favorable term, but the attitude going back to like NMHC, for example, in January was that, we really had no appetite to do negative leverage deals in 2022. And we still don't now. Yeah. And unless there's any meaningful movement in the treasuries and kind of where interest rates are, if your interest rate on your debt is still at 6, those cap rates are going to have to be a lot closer for that to make a lot of people interested in the deals. So you're going to see pricing move just based on that fact alone. However, because you've had so many buyers on the sidelines, I think there's going to be more deals that are pushed to market because a lot of people have come to grips with this. Either A, it was their business plan and they're happy to do it. And they're happy to go along and sell. But also I think you're going to have a lot of people that, their loan is going to be maturing, or they're hearing and seeing what's going on with other people who are in the loan maturity situation, realizing that that's not too far down the horizon for them, and they're getting rid of it. To kind of steal from your path of analogies, I definitely feel like this market has been from the seller's point of view, has been an episode of Pawn Stars, in the sense that someone comes in with, I don't know, some sort of 60s lunch pail or whatever, thinking it's worth $500. And Rick's, called in his expert, usually Big Buddy Mark, and finds out that it's actually worth $100, and now Rick Harrison wants 50 for it. I think there's a lot of sellers that wanted whatever price it was to get returns and have now realized, no, when someone told me off market that my deal that I wanted 80 million for, I'm going to get 60 million for. After 6 or 7 months of people coming back and saying, well, we'd like to transact at 60, they're now realizing 60 is where I'm at.
And once that happens, and again, a lot depends on that. But I think what's going to motivate, loan maturities is one of them, but an environment where there is no out, and looking ahead and seeing things like, and we'll talk about the Fed in just a second here, but seeing how the Fed could keep interest rates high through 2024. There's going to be extensions. There's going to be deals that multifamily lenders work out. But there is also going to be a lot of loans that are coming due in the next year, and that's a high pressure year with high interest rates that are going to make it the math work better if they cut and run.
Well, if
and just cut their losses, or just sacrifice the greater profits and returns that you thought that you would have in a perfect situation. Collect what you have instead of dealing with a whole year of rocky rent growth or just crippling debt payments and other drags.
Well, if I'm not mistaken, they announced that rates are staying where they're at, correct?
Yeah, that was their announcement. Now we can move. Let's move in to the Federal Reserve, because that was essentially the crux of my discussion there. So the Federal Reserve, they issued their statement. They had another meeting, and they said things are staying the same. Interest rates aren't going up or down, and they have this pat message that they only change a few words every time, and so maybe like a moderate will become mild or something like that. But the upshot to all of this, the thing that was a little bit more exciting than their announcement that rates are going to stay the same, which isn't really exciting, their economic projections changed, and I think changed pretty significantly. So where before they had their end of year expectation, now we're right now we're looking at the Federal Reserve Open Market Committee dot plot of where they expect, each of these dots represents a Federal Reserve board member or Open Market Committee member, represents where they think the federal funds rate will be. And it is settled at a more elevated place now than it was settling in June. June's prediction for the end of year, interest rates next year was like 4.6, I believe. And now it's 5.1% for the end of 2024. The end of this year, that it's going to be higher than 5.1%. But by the end of next year, the Federal Reserve says that interest rates predicts that interest rates will be 5.1%. That's really high, I think. I think that there's probably plenty of people that think that 4 is still pretty high. It's better than 5, but that is the upshot to all this is like, there's a new way of thinking. It may not be, as many people were making fun of the idea of transient inflation. It may not be transient in interest rates. Higher for longer assumes that it assumes even an endpoint, as much as it might be longer than something. It's not longest or forever.
Yeah.
And now there's articles that are like, maybe it's higher forever, or at least for an indeterminate time, where we have this equilibrium that settles between inflation and interest rates. Now, again, like, I'm no economist. This is just what I'm hearing. No, if I can call myself an economist, I'm not accredited. That's for sure.
Go for it.
And my hot take is like, maybe this is a paradigm where, the balance between interest rates and inflation is such that you're keeping interest rates high to combat it. And we got to fight this for a longer time than a simple, than to ramp up interest rates high, cause a crash, bring it down. Instead, what if we stay high for longer?
Yeah, I mean, I'm going to sound like a broken record because I pretty much said it, I think, every time I've been on this year. But there's components to this round of inflation that I am all but certain that were not around the last time a lot of these guys dealt with levels of high inflation, or I would imagine it's just, they're freaking out about probably what happened in the 80s, and they're trying to combat that.
Mm-hmm.
And I understand fixing inflation in terms of money supply and everything like that, but there's also plenty of other realms that have contributed to inflation that the Federal Reserve just isn't going to be able to touch or going to be able to fix.
Yep.
And so while I think the numbers in terms of where inflation is heading, I'm curious to see what people are expecting the Fed to do to totally fix it. Now, granted, the last time I talked about the economy in a rather positive terms on LinkedIn, I was told the view from my ivory tower is nice. So I'll dial back any.
I did some digging on consumer sentiment.
Yeah,
because I was, has been kind of the story for the past couple of years, is like, for as much job growth and as much economic activity as there has been, people are a little more bummed about it than they should be, and there is a partisan element, I think, that is
you don't think
maybe the study was partisan. Everything. Listen, if your guy's in there, you're always right. If the bad guy's in there, it's always his fault, right? All the good things obviously come from your political supporters, and all the bad things come from your political detractors. That is my hot take of the week. Anyways, I think that consumer there is a fuzziness in sentiment, and the end of that at the end of the study that I was reading a couple nights ago is like, it doesn't reflect economic activity. Like, economic activity is doing pretty all right. Now, I do think that there's some cracks in the economy, and we can just move really quickly to this Cushman and Wakefield article. All it did really was put the employment situation in context. It was a short update. They have these weekly updates, or bi-weekly or monthly. Well, I think it's bi-weekly. And they this time they're covering job growth, and I wanted to show this chart here. They say that job growth is going down, or at least there's a leading indicator for job growth going down, and that's the quits rate. The quits rate, the amount of people that are switching jobs or deciding to quit their job because they think they'll get a new job. That's going down. So people are less confident that if they tell their boss to or employer to take this job and shove it, they don't want to do that anymore because maybe they want that job. and maybe there's not going to be a job on the other side. But so yeah, the quits rate's going down. Now the wage growth is still fairly stable, but the what Cushman & Wakefield is saying is because of the quits rates going down, probably wage growth is going down. Now we've seen job growth, or the amount of new jobs, kind of steadily decrease throughout 2023. This may not mean that we're heading towards a downturn. It may mean we're kind of heading towards a lower plateau, a lower economic activity than we had when interest rates were high. My other point is to kind of connect this to the Federal Reserve. We may be reaching the end point of a lot of these like super cycles or whatever, the long lagging indicators that are caused by higher interest rates anyways. Now, some people say, it's like 18 months for everything to run, for higher interest rates to run through the economy. So we've got a long way to go.
Yeah.
But some of the longer term ones, we should be starting to see them at least. And again, like, as much as I'm doubtful, or as much as like I think that yes, there are signs that things are slowly slowing down. It looks like we're avoiding the crisis that many people thought we were going to have in 2023 at the beginning of the year. Mm-hmm. All the economic revisions that we've seen and we covered from CBRE, it was like, yeah, we thought apocalypse was going to be yesterday, but turns out it's going to be 2 weeks from now. They keep pushing that forward. I do think that I did want to call them out because I think that there is a lost opportunity if you're always thinking that apocalypse is right around the corner. But at the same time, I don't want to be overly optimistic that things are just ready to turn around the bend, especially for multifamily, because we're coming up to a winter that there may be lower rent growth. It may not be as great as people may hope for.
Well, I mean, this is without looking at a full amount of historicals. General rule of thumb is that the rent growth and everything like that is tends to be lower than usual in the winter, just because not as many people are.
Yeah, that's the typical.
Yeah. I mean, Heather Pardon with, I think she's either with Salon or Slate. Mm-hmm. I did think offered an interesting take on the economy, that it's something that she admitted, and I would admit as well, that there's no hard data to back it up or anything like that. But it seems like in looking at this summer compared to the summer of 2021 and 2022, the as much as consumer sentiment might not be happy in terms of, okay, ags have gone up or milk has gone up or whatever, it seems like there were other things that people were happy about or focusing on. Mm-hmm. It was whether it'd be like the Barbie movie or the Taylor Swift concert coming out, or Steely Dan is back on tour, and the Eagle. I mean, there's just stuff going on that is, it almost seems like, okay, there's more stuff to be excited about. I mean, people are going on tour and everything like that. Yeah. Whereas like 2022, it seemed like the talk of last summer was rising interest rates, inflation. This is more expensive. More expensive.
Yeah,
And the only gap that I really can think of that broke it was like news over like Roe v. Wade for like 2 or 3 weeks, and then it was back to inflation. 2021, it felt like a lot of it was coming out of, this is more, I guess, kind of leading the economy a little bit, but 2021 seemed to be the frustration over COVID and vaccines, and we're still stuck in this, or we can't get ahead of it, and also just the grilling summer of supply chains. And so, as much as people might still complain about what's going on right now in the economy and purchasing levels and everything like that, it seems like there's enough other stuff. I don't know if it's other stuff going on or if it's people. I don't know what the cause is. I don't know if people are talking about different things because they're tired of complaining. I don't really think that's something a lot of people get tired of doing.
Yeah, I love complaining.
But it just seems like
don't deny people that.
There just seems to be a different attitude that's not there.
I completely
at this time last year.
So I completely agree. And part of it, I thought before, maybe was due to like a post-pandemic, like we can never really hope for the best because, post the great financial crisis, great recession, we can never really hope for the best because we've been through so much, and after this lengthy protracted recession of 2008. But I think that there is an element that's different between then and now. In that after the housing crisis of 2008, there wasn't huge inflation that was caused on either end of it, and now we're seeing inflation, and that may be a more a like bigger pain to people in terms of consumer sentiment than the pandemic, than the Great Recession. I thought, my feeling, at least during those years I was living through, was like, yeah, I was pretty bummed out about the economy for a long time. I didn't, I wasn't thinking like, oh yeah, it's going to be easy to just go out and get a job. Whereas in the past 3 years, I thought, at least the labor market is pretty healthy. You'd be pretty confident that you're going to be able to find a job. Now, going to the data here, and I'll pull this up and you can kind of see, and this is just a rough data that I just tried to Google just now. So, my apology.
I'll hold you on that point though. Mm-hmm. Anyone that was graduating college in, I guess, what would it be, 2008, 2009, 2010, that time frame, pretty much anyone that graduated college around that time period will talk about how painful it was to try and find a job.
Yeah.
How the opportunities a lot of times are non-existent. I, applied to 500 places, didn't hear anything.
Yeah.
Whereas I think people in 2020 faced a bit of a, college graduates in 2020 faced some sort of, okay, either my job isn't, the job that they were supposed to have leaving college got canceled.
Yeah.
Or their start date got pushed back, or something along those lines. 2021, 2022, 2023, I didn't hear as many complaints in the economy of, I can't find a job.
Yeah.
Whereas 2008, 2009, 2010, that seemed to be, I mean, granted, I was in all of fourth grade at the time, but it wasn't uncommon to hear of people that got laid off. And that was the general frustration, is job loss at that time. Whereas this time around, it seems like it's like finding work doesn't seem to be a huge issue. Yep. Granted, right now we're seeing some layoffs run through the economy, but I don't feel like it's been inflation that has dominated it. Even then, I mean, granted, it's something that was on as either Indianapolis or Indiana subreddit, and that's not something that's probably the best to use in terms of evidence. But I mean, someone did kind of ask the question of like, everyone's talking about how bad the economy is and prices and everything like that, but everyone I know is going out of town for Labor Day.
Yeah.
Everyone went on a summer vacation this year.
Yeah. Something changed. Yeah, and it could be inflation, I think. But I just want to show the stark difference here. If we're looking at, and now we have the numbers pulled up here for consumer sentiment. Now what we want to focus on is these third, fourth, and fifth column, which represents Republicans, Independents, and Democrats, respectively, their consumer sentiment in the 2008 period.
In that order?
Let me just check for sure here. Democrats, Independents, Republicans. Now, I'm not really looking at, now I'm going to wipe that from my mind, because I just want to look at the number of the low sentiment period that is that kind of precedes and follows the major economic crises. So when we're looking at the 2008 period, we have consumer sentiment in March 2008 that's it's in the 60s or 80s, depending on what your political affiliation is. If you look at the very beginning of the Great Financial Crisis, or the housing crisis, call it what you will, April 2008. That's the first time we see the consumer sentiment in the 50s for any one of these groups. Now that persists until keep going from April 2008 all the way until March of 2009. That's the last time. So we've got about, what is it, April to March? That's about 11 months, or maybe 11 or 12, depending on if you're including all of April or not. But I think, you've got essentially a year, okay? A year where people were bummed out, where consumer sentiment was down after the Great Financial Crisis. Now let's zoom in, or let's say zoom forward, as it were, to the current political climate. We are currently not technically in a recession now. Sentiment may change. But right now we have, so the start of the pandemic, which was, April 2020, that is when we start seeing 50s for consumer sentiment. And that goes away October 2020. So we get like a small, September 2020. So we get a little small 4 months. And then right after the election of Joseph Biden, we have basically we start seeing some of these groups have lower consumer sentiment, and it has persisted for 2 solid years, twice as long as it's persisted. So ever since August of 2021. We have consumer sentiment in the 50s, and it has been the same throughout. It has never dipped above like what 59 or 54%. Essentially, consumer sentiment is like twice as worse or twice as lengthy, twice as bad. However you look at it, than in the Great Financial Crisis. Is that how things are panning out? Is that because of inflation? I certainly think the job market is better than it was during the Great Financial Crisis, or maybe I'm all making it up and my feelings are wrong. And I think the upshot to all of this is that consumer sentiment is a messy statistic, but for as messy as it is, it's not like it has zero influence. So,
well, one culprit we can rule out is 24/7 cable news.
Clearly, that's true.
I don't think that has anything to do with anything.
I agree. or the Gray Report. We are paragons of rational thinking and thinking with your head, not with your heart. I have a lot of passion for what I do, so maybe I do think with my heart a little bit. Anyways, I want to move forward from talk about job growth and see how it may impact the apartment market. Now, there is a short article from it's a kind of a lengthy one, from Jay Parsons at RealPage that does mention job growth as a factor in kind of the impact of whether it's inflation or whether it's just like a slice of a renter's life. Now, you were just telling me, it's kind of good news sometimes for renters when rents aren't too high, and I would tend to agree with you. And I think that the headline that Jay Parsons is describing here, where he says that wage growth is outpacing rent growth again. That headline is a story that apartments are becoming increasingly affordable. It is not his claim or argument in here, nor does he call for room for further increases in apartment rents. However, that might be implied for certain investors and operators. It's gonna happen. Yeah, it's gonna happen. He doesn't need to say it that it happens; it'll just happen. But no, his point is that that income growth outpacing rent growth. It will probably for a while, and that's good news for renters. It's going to be a lot of happier renters. He doesn't really delve into like, well, does this mean higher returns or anything or in the future? He's just saying, yeah, this is actually happening because there is what he says, and accurately so, is a historic surge in new apartment construction. Now, I like this paragraph, so I'm going to read it all. That wave came about in part due to 2021's perfect storm of ultra-low occupancy, high rent growth, plus low interest rates, creating a fertile landscape for apartment construction to surpass 50-year highs. Now, I would say, I gotta love that imagery, right? That is the best use of pastoral imagery to describe high-density housing. A storm rolling in, creating a fertile landscape. That's what you get when it's Jay Parsons writing your article here. But I do agree with what he describes. This is like the paradigm of 2023 right here. Is we're number one, we're in the wake of huge rent growth, and number two, we are in the middle of huge huge apartment construction. Just like construction was surpassing 50-year highs, we were at historic all-time highs for rent growth just a couple of years ago. So,
which this kind of goes back to the point that I'd mentioned of how, when I had talked about the economy and got the whole ivory tower comments, people really don't care about studies like this in a sense.
Yeah, exactly.
I don't know of anyone that has said like, I feel like rent growth is going down.
Mm-hmm.
I feel like I was able to get a pretty solid rent situation because I was looking for an apartment or made the switch from where I was at in January.
Mm-hmm.
But there's a lot of people I know that, be it in anything in downtown Indianapolis, if it's a nice apartment complex, when they got their renewal increase from the, I'd say May to August, or I'd say probably May to August timeframe, it was pretty expensive and they had to move from where they were at. Granted, they went from one place downtown to another, but I don't really know of anyone that thought like, I didn't get as big of an increase as I thought I would, or
well,
actually they really didn't even increase my renewal. It stayed the same. I don't think anybody's feeling that way. And the other one is, they're talking about how the supply and everything has gone up. I mean, America's really bad at building new apartments and building new homes in terms of like getting supply to meet demand. And again, one of those things of, yeah, sure, it might be relative in the sense that before 2019, we're in a good spot in terms of what was being built. But what he mentioned was in 2021 and 2022, I would imagine that those newer construction projects were either getting started or going on when debt was next to nothing.
Yeah. And they had high rent growth. It was like, that was the fertile landscape, right?
They've come to a screeching halt in the end of 2022 and into 2023. And now we're going to have a lag behind because no new construction got done during these periods.
The Stormfather rolled in, created that fertile landscape.
Yeah.
Energized everyone.
Be curious to see what this report looks like in 2025 or 2026. And the other thing is, granted, a lot of it is political fear-mongering, but we have a huge homeless problem in a lot of cities, largely due to the fact that just not enough housing. Yeah,
well, he makes that point too, that what he is talking about when he's describing rent to income, which to give the numbers for it, they say that that number will likely tick back below 23% before year end. Now, 30%, 33%, that is the kind of classic definition of like rent burdened or cost burdened.
Yeah.
And when you're talking about affordability, there are plenty of markets that are above that. If you look at market rate apartments for certain markets. Now, I do think that he does note that this is talking about market rate. It's not talking about the affordable housing group. So that whole category of housing is a little bit more troubled. It may have more, it may have more problems to deal with than market rate, just because of whatever systems that the government and developers have in place. It's a tough nut to crack, and I don't think that we've heard the end of it either. Supposedly, and there's been a few memos, 2 or 3 that we've covered on the Gray Report from the White House, saying like, yes, we're working on getting more affordable housing out there. And I'm not denying that there could be stuff in the offing, but we haven't seen a program we've seen intention, but we haven't seen really. What are they called? Shovel ready? I was gonna say shovel ready
projects.
You beat me to it. They're not there, but you can't snap your fingers, get the shovels in the ground. That doesn't happen.
That's pretty good, because I think last time I was on, I used a George W. Bush quote.
Nice.
This time we used
just cycle through.
One, so.
Yeah. Next time you can use a Trump one and then a Biden one will be perfect. Get a lot to choose from. A lot of great opportunities.
Yeah.
So I think that the upshot the reason why I paired this RealPage and Cushman & Wakefield was to say, one way you can look at it is, this rent to income is doing pretty well. Now, if you look at the future, maybe that rent to income may that may not be as friendly of a number if wage growth goes down a little bit. But I think that there's a suitable cushion. We're not in dire straits by any means, and it redounds to the benefit of renters, if they have a little bit more money. And I think, like everything, or like many things that I'm going to talk about this episode, or have talked about, we're in the wake of such huge rent increases, and I think that's still weighing on people's psyche. They're not thinking about how much rent growth they saved by not. They're thinking about the pain of paying rent every time. They're not thinking, oh yeah, well I'm glad it's not $100 more. I'm so grateful. They're just mad that it's high as it is. And so I think that there was a psychological or economic ceiling that was hit, along with apartment supply. I think part of it is it got too expensive and people were less willing to pay for it. Like, that had to have happened at some point in the last year. It's not just interest rates. It's not just apartment supply. Part of it is just, if you raise the prices too much, people aren't going to pay.
Yeah.
I don't know. That is way beyond my economic training, that whole price demand thing, but I don't know. Okay, so moving on from wages and the apartment market, I want to talk about one more quick update on the apartment market itself, apart from wages. Yardi Matrix made their prediction this week, very recently on, they gave an update to their multifamily rent forecast, and you can see it right here. It is, it's 3.1 at the end of.
Oh, wow.
At the end of the year. Now, okay, so This is here's
really went on a limb there. 3%.
Yeah, well, that's the historical average. Now, I think that there's a lot about 2023 that is different from the historical average. I do think it's more normal of a year than it was, in the past 3 years. But I still don't. I still think it's weird enough. The rules are not going to apply. The standard rules.
I don't know. That's pretty bold to just say it's going to be whatever the historical average is.
I'm saying, now I did a little bit of math here. So currently, year over year rent growth is at 1.5%. Now, asking rents, if we're talking about since the beginning of the year, asking rents have increased by an average of 2.1% since January of this year, which they say is a much slower pace than in 2021 and 2022. All right, just as an aside here, they're not wholly specific in their update to the multifamily rate forecast in the text itself if you're going to download this document from Yardi Matrix. No. However, in the larger frame, at which you can see right here on our screen, however, the podcast listeners may need to close their eyes if they're driving the car and form a mental picture.
Or pull over.
Well, you can kind of use your ears to listen to the traffic around you, and trust me when I say that what's on the screen here is multifamily rent forecast relatively unchanged at 3.1%. Now, I'm assuming here that they mean by the end of the year, rents are going to be 3.1% greater than they were at the beginning of the year. Is that fair to assume?
Sure.
Okay.
I mean, I'm just laughing. 3 is kind of the historical average, what a lot of people put down on their underwriting if they don't have anything that's going to lead them to believe that rent is going to be ridiculously higher. And I am curious to know how much time, money, and effort went into the research to say, what it usually is.
As what it's going to be.
This is what we think it's going to be.
Well, it could land in the same. It could land in a boring number, but for kind of interesting reasons. And
let's put a decibel behind it.
Well, okay, fine. They say 3.1. Now, I still think that it is notable that they are kind of sticking to their guns at this 3.1 because they say there were no major changes to the forecast for this update, and our overall economic outlook has also not changed. So 3.1, and right now it has changed 2.1 since January. So we've got about 1% to go. Great. So in the next 4 months or 3 months, depending on what they're using as their starting point here, we have to get 1% more rent growth. And Yardi Matrix, their last rent growth was like 0.1, or it's maybe approaching 0. We could have negative rent growth very, very easily because of typical seasonal effects.
Which, as a renter, is fantastic.
Which as a renter, it's fantastic.
It's about damn time.
Yeah, but so we could have a seasonal downturn that happens in October, November, December. We could get the numbers for September and have negative. And Yardi Matrix could show negative rent growth. I think that 3.1 is a little optimistic. I think it's going to be closer to 2 than 3, maybe even below 2 from Yardi's numbers. Fine. Now others have different, but
here's the thing with that. They're not going to get a lot of flack if they say we are expected to be 3.1% and it's 4 or it's 2. They're going to get in a lot of trouble. Well, I shouldn't say a lot of trouble. There's going to be some head scratching and calling out if they thought it was going to be 7 or 8%, and instead it's 3.
Yeah. Might as well get it wrong get it wrong by guessing like the historical average, then get it wrong by guessing something that's outside the norm.
And likewise, I mean, there's going to be a lot of eyeballs on a report from a research group like this to if they say like, no. Rent's going to go backwards.
Yeah, that's a good point. Is like they're the source. You got to kind of pay attention to the source. I think that an outfit like Apartment List, which actually has rent growth recorded at slightly lower than other sources, they are serving a different client and audience, maybe composed less of apartment owners, investors, and operators than that's like RealPage and Yardi Matrix. They have property management and investment management kind of software and services that they do, and so they may have a little bit of a rosier picture when it comes to rent growth than and the fact that that it could go up than Apartment List, which has great data, but they may be more willing to say that it's going to be slower because a lot of renters could be reading that research and looking to see where rents are. Maybe a little more happy about that lower number.
Well, I don't think I'm curious to see how something just seems off in the sense that the reports that we had just listed on here is that wage growth is outpacing rent, and so it's like, okay, well then in that sense, you think there's room to move, but then you're hearing more supplies coming to market.
Yeah.
So
I think that and that's a good point. So we've talked about, let's say 3 or 4 things here. But job growth and apartment supply, let's say as a couple of these issues that we described, I think that apartment supply is going to be and has been a much larger factor in rent growth than job growth or wage growth. And I think that if 2024 is anything like 2023, barring a huge recession, apartment supply is still going to be the determinant rather than looking at how much wage growth there is. I just don't think that wage growth is going to move as dramatically as apartment supply has.
The other factor that I haven't heard too many people talk about, that could be, and I'm just missing it, but college loan payments are going to be
actually there have been a few people and maybe even mentioned in some of these reviews and stuff, that's a huge factor for sure, because that exactly identifies a slice of the moment in life where a lot of apartment renters are at, paying back their loans, and once those payments start, and I don't think they all saved up. Like I was been reading a few articles.
The ones I know have not.
Yeah, like who does that? They just graduated from college. They don't have wisdom. They're not gonna be prudent. At least that, going from experience, that's not like a prudent time of your life. You will take the missed payments and you're gonna spend money on go out to bars or something.
Taylor Swift concerts.
Exactly. But
Barbie movie tickets.
There may be depending on whether the Biden administration or the outcome of the 2024 elections, there may be further, I don't want to say concessions, but student loans may not be as burdensome, depending on if some of the Biden provisions are enacted that kind of cap interest rates for income-based repayments, or they don't let the principal grow in certain situations if you're having interest and income-based repayment, and there's kind of other relief that they're providing. It's not as material as what maybe they had planned, but it still could make a difference, and that would be really meaningful. The fact that they're turning it on after having it off for a few years, that's got to be an impact. And I'd love to see, and it's like this month or last month, they're just getting started. So
the other thing that I'm wondering is what effect does it have on rent growth, but also what the effect is on people that were in the later stages of, call it their 20s or maybe their early 30s, but they're in the later stages of being a renter and they're about to enter that phase of a homeowner and realize, they
could keep renters. Yeah, that's a good point. Yeah, so it could do both. And that'll lead kind of to
use another W quote from his Secretary of Defense, Mr. Rumsfeld. A lot of unknown unknowns out there, boss.
He got made fun of for that. I still think that is a worthwhile and valuable distinction. There are some things you don't know that you don't know.
Mission accomplished.
Okay, great. So this will be the last one we covered. We won't be able to get to the core logic and Moody's Analytics piece that talk about single family rentals.
Guess I'll have to come on next week.
That's true. We'll have a catch up, maybe a midweek catch up or something like that. This is a short article from RealPage again. This is from Julie Bunch. I've actually I've read from her before, and the RealPage research team has a bunch of great writers. This one is similarly valuable information, describing what we kind of have been tracking throughout is Class A rents. Class A rent performance is weighing down apartment markets, and it's like I don't want to say physics, but it's definitely it seems like a very rational, logical, that it would follow that a cheaper Class A would lead to cheaper Class B would lead to cheaper Class C, and I was just kind of thinking like, okay, I'm going to drop my paper, I'm going to take off the screenshot, and we're going to talk to you like a human being.
You haven't been doing
podcast listeners will. All right, never mind. I'm taking the screenshot away for podcast listeners, and I'm looking Addison directly in the eyes, and because I want to see if I'm way off base here. I think that some of these, and I'll have to ask Katrina, our head of property management. I think that some of these apartment listing companies will sometimes show you apartments that are more expensive than your budget. I think if they don't, then that's a waste, because you got to have some kind of like aspirational You'll put in like 2,000 or whatever as your cap, your max rent that you're willing to pay. They're going to show you some 2,100 ones.
So I feel like I would almost say it's kind of the opposite in the sense that there's plenty of times on now apartments.com can have it, and Zillow can have it as well, where you do put in, let's say you want a 2-bed and you want to see if you can get one for under $2,000, and they'll show you some where it's like, hey, wow, that's a really nice apartment complex that I can get a 2-bedroom at. It's not until you do a little bit of digging, you go into the apartment like they have what Zillow and apartments.com are telling you, but then if you go on the apartment website and look at what they're actually listing, there's there's a delta between the two.
Okay,
and
so
it's not in favor of the renter.
Yeah.
But the other part of it is
kind of like a bait and switch a little bit.
Yeah, and so what I'm wondering oftentimes is like, did at one point they have one for 1,700 and so it's staying on there, or are they luring people in of like, well, all right, this is the best I can do?
Yeah. Okay, so I'm entering 1.5 as my minimum and 2,000 as my maximum. And I'm going to sort by rent high to low on apartments.com here. And let's see if my theory is correct. Now they've got a range. So the first one that comes up is one where it has a max of 7,000. Now that's kind of cheating. All right. Now we're looking at prices and floor plans for the artistry. And
look at that range.
Yeah. The range is 1,300 to 3,443. My point that I'm trying to make here in this convoluted exercise is that whether it's through the clever machinations of an apartment listing service who are suggesting apartments that may be slightly out of your budget that you stated, there may be situations where a Class B plus renter is like, if I spend a couple more hundred, I could get a really nice apartment. And they bump up to that Class A. Well, guess what? That apartment in that Class B is now empty. And so, or Class B plus or whatever. And so the operator of that apartment's like, well, I got to fill that. So I'm going to lower the rent a little bit. And then a Class B regular is looking at that B plus, and then he's moving up. And then the C classes, they're moving up, and it cycles and cascades like, it's kind of like physics, right?
Yeah.
All right, great. See? Okay, perfect. I really wish.
But also, I would say there's some people that like, there's movement up. I don't really ever hear about movement down. Like you're never
interesting.
I don't think you're ever going to hear of a Class A going to Class B or B minus.
Yeah. I mean, barring like kind of the economic situation, and like a recession or whatever. But I think that this effect, even in general, call it what you will, no apartment is built. Now, Spencer said this before, and we've kind of said this. New apartments are generally Class A apartments. They're more the nicer apartments just because of kind of the profit margins and it's just the way the value of apartments are is like older stuff is worth less, and it's kind of like, I don't know if it seems common sense, but that's kind of how it is. Even if they somehow were producing Class B apartments, all of a sudden, and they came into the market, I think that would put pressure on Class A rents too. It's because the supply of apartments in general, if that increases, then that's going to lower prices on the whole. Now, I'm not sure, how that shakes out exactly. I think that in the pandemic there was a clear demarcation between A and B, C apartment rent growth, and they are unique. They respond uniquely to different to different economic trends, whether it is like wage growth of for kind of workforce housing population versus like maybe remote working, like the white collar job.
The other factor into that though is, and I thought about adding it earlier when they're talking about rent growth, is there felt like during COVID, there was another valve that people were willing to use that they aren't going to use now in terms of whatever struggles are going on rent growth wise or with economics. There were a lot of people in 2020 that were willing to live at home after graduation or willing to move back in. Now, in some cases, it could have been because of job loss, but kind of the attitude of, why do I need to be in, if, let's say there's someone that grew up in the Indianapolis suburbs, their parents live in the Indianapolis suburbs still, why would I go and pay rent downtown when I'm paying all this money for an apartment
Yeah.
for an apartment with a really nice pool, but I can't use the pool.
Yeah.
Or I can't use the gym or any of the amenities that come with it. Also, nothing's going on downtown. I can't go to I can't go out. There's no nightlife. There's no nothing else. I'll just go home. Or I'm sorry, live at home.
Mm-hmm.
I don't think there's really anybody shouldn't say there isn't anybody. I don't think there's too many people considering that this time around.
Yeah.
And so there was that valve there the last time.
Yeah, I think that, that was actually a big story in the financial crisis. People moving back in with their parents. I think that could happen if the economy gets bad enough. But yeah, I don't think it's happening right now. And it's certainly, I don't think it would be caused by rents in and of themselves, driving people to like kind of move in with their parents or move in with roommates or anything like that.
Well, I mean, I could be wrong, but I think to a certain extent in 2020, it was more of a like, this makes financial sense, where normal bad economic times are like, I don't have a choice.
And one thing that I kind of didn't, I should have noted earlier, we're talking about how the winter is going to be rocky and how, there probably could be negative rent growth, and how, supply is pushing down rents for a lot of markets and for sectors across the board. And, there's all, and maybe job growth's going down. There's all these kind of negative seeming trends that are happening, but ultimately yes, the fundamentals for multifamily are sound, and the apartment supply issue is something that is a little bit more temporary than you might think, that might be assumed. Yes, we're building a lot now, but that's not going to happen forever, especially because we didn't do a whole lot of projects. Projects haven't been getting started ever since interest rates started rising. So there are discrete reasons why the apartment supply issue, it's not going to be a glut. Fundamentals are still strong. Household formation still doing pretty all right. I think it's growing again after it shrank for a little. These recession predictions in general, there may be a downturn, but they keep getting moved forward. So if you have a partisan reason to be cynical, I'll give that to you. But if you're willing to have hope, I like to think that things are okay. And there's a reason maybe why CBRE reported that all these investors are looking at multifamily. It's because maybe they know that there is a fundamental stability, that this housing story, the story of the housing shortage or housing affordability crisis or whatever it is, that's a very valid point that is going to be true in 2023 and 2026.
Yeah.
So I think maybe we can close with that, unless you have something stuck in your craw that you want to, maybe I got something wrong. If I did get something wrong, viewers and listeners, be sure to leave a comment describing right. And if you timestamp it, that'd be perfect. Yeah. So that I can correct it for future and notify. And maybe I can have corrections next week. I'll bring you in. If you got anything wrong, bring you in. You can do corrections. We can keep the record, and we can be a fair and balanced source of multifamily news. Another fair and balanced source of multifamily news is the Gray Report newsletter. It is the greatest and best source of information and research reports on the multifamily industry, real estate, and the economy. It is, if you go to www.graycapitalllc.com/newsletter, then you will sign up for free and get a free weekly newsletter. Also, please visit, you can also visit www.graycap.net. It's pretty sweet, easy. Or go to grayreport.com, where we update every day on the multifamily market, commercial real estate, and the economy. We try to keep on top of everything, on top of all the research. If it changes, we're there right now. I think that we have described the new environment that the multifamily buyers and sellers and capital markets are facing, the shifts for the individual renter and owner and operator. And we'll be with everyone in the future, staying on top of things. Thanks for coming, Addison.
Anytime.